Okay, good afternoon, everyone. Welcome to the final session of the day. We're delighted to have some terrific panelists with us, which Georg will introduce in a moment. Before he does, I'm going to very briefly, in 2 or 3 minutes, summarize our recent paper, The Political Economy of Global Stock Exchange Competition, which the conference organizers thought would make a useful framework for our panel discussion. So the first point is that it's not all about regulatory competition for IPOs. We're all familiar with the age-old race to the top or bottom framing. More recent discussion of whether there are too few public companies in the United States. These are obviously important questions, and there's a rather large IPO scheduled to launch in a few hours. So we're not arguing that IPOs are unimportant, but simply that this framing masks a lot of important developments in the public capital markets today. So, for example, stock exchanges are private, profit-oriented organizations today, and they derive far more revenues from data analytics and other services than they do from listing fees. From an issuer perspective, valuation, liquidity, and visibility are at least as important today as listing standards. And perhaps most importantly, with the tremendous rise of the private capital, the major competitor to stock exchanges today may not be other exchanges, but private capital itself. Second point, perhaps more important, is that stock exchanges are strategic assets for the governments that host them. This is something that's largely been left out of the debate on global stock exchange competition. One exception is a piece by Tobias and co-authors on the strategic importance of the success of the European Union Capital Markets Union. So the point is that governments themselves have very important both economic and geopolitical interests in maintaining vibrant domestic stock exchanges. Economically, obviously they have an interest in fostering innovative young companies, but also, and very importantly, retaining those companies at home. There's evidence that a foreign listing is often the first step in the gravitation of talent, IP, and assets abroad. Also, domestic exchanges can respond to home bias by investors and can also serve as kind of transmission belt or instrument for conveying government policy, for example, in corporate governance, something I think we'll hear about with respect to the TSE. Of course, in today's geopolitical environment, which we've heard a good deal about, stock exchanges have taken on the characteristic of a choke point, to use a currently in vogue term. They can be used to limit access to a scarce resource on the part of adversaries. So there's a lot going on in the markets. This paper is really just a call for broader interdisciplinary work on the public capital markets today. So with that as a framework for discussion, I'll turn the floor over to Georg to introduce the panel and get the conversation going.
Thank you, Curtis. That sounds like a great paper. Let me just say how pleased we are that we have a wonderful panel here tonight who will test the ideas from the paper, or more interestingly, give us some feeling of what is happening, as we academics always say, in the real world out there on the ground. So from left to right, we have with us Thom Abbott, who is head of Southeast Asia with the London Stock Exchange. Next comes Chinyi Chu, who is managing director of the Singapore Exchange here in Singapore. Sharon Lau, who is a partner with Latham and Watkins, and Kazuhiko Yoshimatsu, who is managing director of Singapore for the Tokyo Stock Exchange. So you see, we have representatives from some major exchanges and practitioners involved in that very business that this research is all about. And it's really, really wonderful to have you with us. Thank you so much for making the time and for being here with us. I'd like to open the discussion by starting maybe with the left with Thom. So on the listing front, the London Stock Exchange obviously has a number of major competitors globally. But the LSE group broadly has also become data and post-trading powerhouse. So can you give us a little bit of a feeling of how the LSE or the LSE group views this competitive environment and how it is responding to those phenomena?
Of course. Thank you, Georg, and thank you for having me today. It's a pleasure to be here. I think taking the group side first and just sort of getting that sort of out of the way. Obviously, about 4 years ago now, we, as LSE, already quite a diversified player, owning businesses such as FTSE, the index business, LCH, the London Clearinghouse, took the decision to acquire Refinitiv, the old Thomson Reuters data business. So suddenly we went from being a group of around about 3,500 people globally to over 25,000. And as you rightly point out, that along with it brought a lot of data and analytics services, FX platforms, trade web ownership, the fixed income trading platform. So becoming a much more diversified business. Some people, and sort of one of the other bits of competition I'll perhaps get onto, sort of saw that as, you know, are we worrying less about the first three letters of our name, the LSE bit? Obviously, in terms of, you know, if you look at the overall picture in terms of revenue, that's where it is. But, you know, factually, globally, we stack up as an exchange business in terms of trading volumes. Still the largest equity market in Europe, second largest debt market anywhere globally, and the largest funds market. So still a hugely important part of the business, and both our group CEO and the stock exchange CEO are very much on the front foot, getting out there and making sure that's well known. The other advantage it has for us is it creates a bit of a moat in terms of our business. You know, we obviously, at the time of the Refinitiv transaction, there were approaches by Hong Kong. You know, in the past we've been, I'm sure people in this room will be aware of the Deutsche Börse discussions. We previously owned Borsa Italiana. So in some ways for us, it actually gave us a firmer footing. And look, half my family are Czech, so I'm not a huge fan of Brexit, I'll be honest. But in that environment, it also gave us the other part of sort of the competitive edges. Post that, as an exchange, one of those big problems was our rule set. So about 5 years ago, we went through a process of review and then huge reform. And I think we're quite confident in saying we are now possibly one of the most accessible markets from a listing and ongoing perspective anywhere globally. So that was one area that we addressed, and that sort of finished, or at the beginning of this year, over a long sort of a root and branch reform of the listing rules, prospectus regulation, looking at pension reforms, looking at governance, corporate governance code, stewardship, etc., all with the a purpose of making sure that it worked for our issuers and those coming to market, and we could continue getting that capital in. I think in terms of competition, obviously sat here in Asia, I think a big thing that I'm keen to emphasize is we don't want to drag companies kicking and screaming in London for the sake of it. I think maybe some of our peers not represented on the panel perhaps have been a bit guilty of that in the past. And you know, I think that you know, that's obviously where a lot of competition we face in the UK has been some of those UK stories that have gone to the US. But if you actually look at how they've performed, we keep the statistics on this, of those that have raised over 100 million US in the past 20 years, of UK companies that have gone to the US markets, 3 are trading up out of 22. 11 have now delisted. And the performance of the others is down on average about 79%. And I think for Asia Pacific, you see this with Singaporean businesses, you see it with Korean businesses, a lot that have struggled to have that quite domestic focused US market, you know, really take these companies as seriously as they perhaps should. So from that sort of angle, the competition obviously in the UK focus in media, another one of our big competitors at the time in the UK, I think, has you know, been one of the approaches that we've been just trying to be a bit more front-footed and also make sure that our rules and regulation match that, and then we have that support of the wider group there as well.
Great, thank you so much. And Chin Yi, turning to the Singapore Exchange, you have just recently completed a number of reforms with a particular goal also of making the Singapore Exchange more attractive and more competitive. Can you tell us a little bit about those reforms and, you know, what motivated them, the background?
Yes, thank you very much, and hello everyone. Very happy to be here. There's been a 1-year journey that's been completed earlier last year in November, where the government-led equity markets review group studied the equities market and proposed a whole range, a slew of measures to reinvigorate the equities market. Now, before I go into the motivations, perhaps just a little bit on the traditional role of a stock exchange and how that's really changing, to give a bit of context, and how we see the purpose of a stock exchange in a country is really to provide pricing, transparent pricing, so that people can price their risk, to allow people to transfer their risk through the buying and selling of instruments. And from a broader national level, it is to allow enterprises to fund their growth, and also to allow national savings to be funneled into the companies, so that everyone partakes in this sharing of wealth as the nation develops. Now, over the years, this domestic focus and domestic role has obviously changed a lot with connectivity, with global flows. Now, capital is basically global. And from that perspective, while the exchanges serve a very strong domestic role still for its own national industries, where capital flows is totally different, and it gravitates towards markets with the highest levels of liquidity. And that results in a negative cycle for anyone not having a strong level of liquidity to attract or sustain investor interest. Companies won't list because the post-listing valuations don't work. And obviously, once companies don't list with a stagnation of the supply chain, investors don't trade. And then the stronger, high liquidity profile venues just grow ever bigger. So that's the landscape we were staring at. And from the equity markets review group's perspective, given Singapore's branding and the efforts put in to build ourselves into a financial hub, given especially the recent efforts to build out our private equity and venture capital space, it would have made very little sense not to complete this capital formation chain by having the public exit venue in Singapore and ensuring that we can do the value capture through the chain. And how they looked at it was this, that you got to address the demand side, which is the lack of funding. So the government has set out a grant to get active fund investors to go into the market, on top of other measures to ensure that there's sufficient visibility. On the supply side, a whole slew of measures to which I will talk more about in a bit, to facilitate the listing of firms that will then increase the supply, the right sort of firms, of course. And the two things I think I want to touch on in particular will be, from a regulatory perspective, there was a lot of analysis on it. And I think in the recent years, there's been a trend towards describing the changes everywhere in the world as a race to the bottom or a race to the top. What the approach we took was really, it's not so much, of course you must benchmark since you're competing globally, but the most important thing is to make sure that the lived experience of regulation for the companies that come in, for professionals, is consistent with their expectations of what a developed market, a disclosure-based market ought to be. And that's where we found some friction, where merit-based judgment in areas would have been a bit dissonant with their concept of what a disclosure-based market operates. And so we targeted those. And we made changes to make sure that insofar as merit judgment of the regulator is concerned, it is limited to the correct areas, areas where you cannot let go, areas like the character and integrity of the management, or the strength and I guess I struggle to find the correct word, the reality of the financial model that's being disclosed in documents. And after that, you've got to let the market discipline have a strong role. Because ultimately, that is what gives you the reliable price, and that's what draws interest. The second part is what we felt was needed to make it very, very sustainable is that companies listed on our stock market, and in fact, any stock market, must, first of all, be suitable for the market. And why I say this is that I think, as Thom has brought up previously, certain companies do well in deeper or bigger markets when they are of a certain size and their business is of a certain profile. Most other companies probably won't do well because they are just unknown in other markets, and there is still a very strong domestic focus worldwide for each investor for their own markets. So what we did was that when we looked at it, there were two things we thought we needed to do, which was first of all to put in programs or measures to ensure that the companies themselves have a very strong value-focused mindset in creating shareholder value. We call this the Value Up program. It focuses on disclosure, focuses on plans, and ultimately focuses on making sure that company management has a mindset. Secondly, part of the Singapore DNA is that with a population of give or take 4 to 6 million at any one time, it's in our DNA to look for partnerships and connectivity. And what we did was to create I think first in the world, linkage with the NASDAQ to address companies who, given their business nature, really would find it difficult to sustain investor interest in the US, but would benefit from listing there to get valuations from the much deeper capital markets. So it's a dual listing bridge and giving them the best of both worlds, raising capital from both parties, but having the investor exposure here in Singapore. And through this, we hope to create a very sustainable cycle of increased liquidity and, most importantly, visibility among the investors, while sustaining I guess, what's good for Singapore in our reputation, which is very strong regulatory foundation.
Sounds great, many things. Katsunori, how do you position the Tokyo Stock Exchange now? Are you also competing in terms of listings and liquidity, or how do you see the comparative advantages of the Tokyo Stock Exchange on the global marketplace?
Hello, everyone. Thank you very much for inviting me, and I'm very much honored to meet you this time. And as a Tokyo Stock Exchange Singapore, we are doing two types of activities in here. First one is inviting potential investment from global institutional investors to the Japanese market, equity market. And I'm covering Middle East, India, Southeast Asia, and Australia. And also, second mission is inviting potential IPO companies. Now we are focusing on the ASEAN region, Asian region. And as you may know, we have been doing improving the corporate governance reforms for the Japanese companies for over 15 years. I'm used to be the first generation of team members. And we spent almost over 10 years to improve the basic corporate governance system to the Japanese companies. And in that meaning, we could achieve the increase in the board and outside the directors, and also improve the independency of the board of directors, and also unwinding the cross-shareholding and so on. And right now, we currently the Japanese stock is investable for the global institutional investors at this moment. But at this moment, you may know, in 2023, current investment boom in the Japanese market is have just started in 2023. At the time, we request to the Japanese companies to change their mindset to much more focusing on capital efficiency. This is a significant shift from deflation economy to inflation economy. Now we are trying to change the kind of mindset of the corporate managers from the defensive mindset to the much more, more positive, aggressive management of the corporate itself. So in that meaning, currently, most of the global institutional investors have just had confidence in Japanese stock market. That's why since 2023, we had a lot of global institutional investors from the United States, from UK, and from the Asian region. But at that time, we had a lot of investment from Japan Watcher, global institutional investors, but they were Japan Watcher in 2023. And in 2024, we had a lot of investment from Japanese domestic institutional investors and retail investors by using the tax-free investment scheme, NISA, Nippon Investment Tax-Free Investment Scheme. And in 2025 and currently, now we are facing the new trend. Currently, now we are facing the new investors from all over the world. Because past 2 decades, Japanese stock market has marked low performance in the 2 decades past. But currently, U.S. market is facing uncertainty, and also the Chinese market is slowing down. That's why many of the investors have to follow the Japanese market at this moment, even passive investor. That's why now we're facing many new investors. That's why sometimes we're facing sometimes market drop, but soon coming back. And actually, we understand that, of course, and now we're competing a lot of neighboring countries and U.S. market and UK market and all over the world. And but of course, corporate governance is a kind of necessary condition for the investors. That's why we try to encourage, we try to improve the corporate governance for the investors. And that currently, now we introduce PBR and PER, such kind of measurement way in the market. That's why we can bring, currently we can bring the, how to say, substantial communication, very much constructive communication among the companies and the investors at this moment. And that's why now we have very much confidence in the market growth in the coming periods.
Great. Okay. Thank you so much. Now, Sharon, I don't want to ask you, which of the three pitches you found most convincing, but more to the point, maybe for the audience of interest, that Sharon has been involved as a legal counsel in many IPOs on Asian stock exchanges, including a very important example, recent IPO of Singapore-based company, software company, I think, AvePoint, and that was the first dual listing by a first NASDAQ-listed firm back in Singapore, right? So we're curious to hear your experiences, and also what do you think are the factors that drive these decisions on where to list, right? And what factors cause firms generally to list outside of their home market, or maybe to return home, as in your case. Maybe you can reflect a bit on that.
Sure, of course. And again, good evening. We were conscious, obviously, we're standing between you guys and probably more drinks and dinner, but very honored to be here. So this is an interesting question, right? Because when you sort of think about, and every exchange has their pitch, and of course there are quite a number that are not represented here who are all in Singapore as well. And just the notion that you have Thom, sitting in Singapore, right? You have Kazuhiko-san sitting in Singapore. Why are these exchanges in Singapore? The NYSE is here. The Hong Kong Stock Exchange comes probably more frequently than you would like them to, right? And NASDAQ has just, opened a new office in Singapore as well. But I think interesting, so for me, right, my practice is capital markets, and we list companies all over the world. Latham is a US firm, and so we do our fair share of US IPOs, but also we work on IPOs in the region, in various stock exchanges, and obviously very much in Singapore. And so to some extent, we are, as a firm, pretty agnostic. If a client were to ask me, where should I list? The real answer is, I'm fairly agnostic. But the truth is, the shopping around for exchanges, and I do want to address the race to the bottom or the top, which I found very interesting in the paper, but the shopping around for exchanges actually, for most companies, doesn't actually serve them well, right? There are the SpaceXs of the world, yes. There are the C Limiteds of the world, there are the Ubers and there are folks like that, but for the vast majority of these companies, listing on a stock exchange is the natural capital cycle. Whether it's for a founder that dreams to list on the stock exchange because there's a lot of national pride to do so, right? Or for the exiting private equity and venture capital investors, or strategic investors. For any of those investors, the exit, other than through an IPO, other than through an M&A or a trade sale, is very traditionally through an IPO. And you're still, despite capital being global, I totally agree with Chinny that capital is absolutely global. Those pockets of global capital are only, again, right, available to a certain number of companies. And the truth is, while I think if you ask any practitioner or banker, ECM banker, what is the most important thing? The first thing people will always say is liquidity, because liquidity ultimately, informs valuations. And why list on a stock exchange if your day one valuation is not giving you the multiple that you expect your company to have? So as a basic principle, that's absolutely true. But if you stick with that basic principle, then that would necessarily mean that the theory of it should be, right, that you then explore the exchange that would give you the best liquidity and the best valuations. And in some part, That obviously has a lot to do with why over the years, especially with the tech cycles coming and going, there were many tech companies or companies that branded themselves as tech, flocking to the US at some point. That explained why that when SPACs, special purpose acquisition companies, were a thing back in 21, 22, kind of really all fizzled out a little bit in 2022. Again, we saw many companies that really had nothing to do with the United States flocking to the United States. Obviously, as a US lawyer, that's perfectly fine from my perspective, right? Not so great from the company's perspective, right? So I think when you start peeling back the layers and you move beyond the question of the day one liquidity, and I think actually the recent cycles have been very beneficial for the more domestic stock exchanges, right? And I guess London is going to be slightly different, right, than say Singapore, for example, because I think it's shown many of the domestic champions that we have, whether it's tech, whether it's AI, biotech, EVs, semiconductors, I mean, you name it, these are the healthcare, these are all the sort of hot sectors right now, globally speaking. I think they're looking at these cycles and they're asking themselves, do I chase the day one valuation, or do I look at something closer to home? What is the liquidity in the trading market? That is, of course, very, very important. And I think that the kudos to the stock exchange here and the MES, the activities that the reforms that Singapore has will go, I think, a long way in catalyzing that. And that is important, right? Because if that doesn't change, even if you're happy with a fairly muted day one valuation, if you're not going to be able to trade out of the stock and have active trading in the stock, that's not going to be great for your stock as well. The other thing that I think people look at is that founders and companies look at is they look at the financial profile or the profile of the exchange that they're listing at. They look at the services that are available, within arm's reach of the stock exchange. Is there going to be good research coverage, for example? Because again, you can't have liquidity if research analysts are not covering you. There are regulatory considerations, right? Early stage growth companies, biotech companies, perhaps pre-revenue companies. Not every stock exchange is going to permit them to list. Peer listings are very important as well, right? And so, while if I were a space exploration company, even if I were a Singapore company, if I were a satellite company, even if I were a Singapore company, I might not naturally look to list in Singapore simply because there isn't someone else that looks like me down the corridor on the same stock exchange. It's the reason why more tech companies list on NASDAQ and more blue chip companies traditionally thought of list on NYSE, because the peer valuation and the comparison is also quite important to all of these folks. Just to address the race to the bottom question, I absolutely disagree that there is a race to the bottom just because stock exchanges compete for the best assets, right? I think that is oversimplifying, the landscape. Ultimately, when you think about an IPO, it is the culmination not just of it's a very complex transaction to put together, and you're considering not only the regulatory rules that the stock exchange has. Just because the stock exchange gives more waivers to one company versus the other, we like to talk about how the stock exchange laid out the red carpet for one issuer versus the other. Singapore famously, we started looking at our multi-voting shares. When we were looking at Manchester United, was that laying out the red carpet or was that not, right? My premise is it isn't, because that is just one aspect, right? I think the rule changes that any stock exchange, as well as the a financial services regulatory authority should look at, really needs to mirror the way markets have moved, right? For SGX and MES, these rules were written a very long time ago, right? Same thing for London, right? It really is a maturing of the market. It's a maturing of the investors. It's also a maturization, if there's such a word, of the advisor community as well. Because as advisors, we have to be, the companies that we're taking to an IPO, we're also giving opinions, banks have commitment committees, and so you have to look at the entire ecosystem, and the ecosystem is bringing that national champion to list, and it's not just about the race to the bottom.
Okay, great. Thom, do you want to come in?
Yeah, I would mind coming on a few points. I think the liquidity one, and Sharon, put it right. I think there has been a bit of a reassessment of that in the past sort of 2 to 3 years because of whether it was the SPACs that went wrong or whatever it might be. I think it was also an oversimplification, and then probably lawyers are probably the least guilty of this of the advisors, but of the advisors there is also a little bit of financial incentive that needs to be taken into account. Right. Look, if you look at liquidity, obviously the US every day trades the most in terms of value. Well done for working that out, everyone. You look at valuations and you have 7 of the largest growing companies and whatever will happen later on this evening, that dominate the S&P 500, the most simple way of looking at the PE. So obviously, if you look at just the PE ratio of various indices, you'll see that they're at, 23, 24 times, FTSE STI probably down at about 12, 13, HSI in Hong Kong about the same as well. But then if you factor in the growth and if you look at the PEG ratio, you actually see that it evens out. Okay. So the valuation, and we're talking about capital being global. If investors were that stupid, they'd only invest in one market, but they're quite rational. So they'll make sure to actually look at each individual company on its own merits. We've done, it wasn't ourselves at UBS. An economist called James Arnold did quite a detailed piece looking at the number of companies trading in US versus UK and Europe, trading at premiums, and you see that actually it's based on the fundamentals of the company. I mean, maybe as an exchange, I shouldn't say this, but then to Sharon's point, it's about those other services, peer sets, research, etc., that form a bigger part of that. Similarly, liquidity. If you actually look at the percentages traded of the free float every day, you actually see a much more even picture. Singapore is at about 0.56% of the stock market trades every day. Okay, fine, the US and the UK are up at about 0.8%, but then if you look at Hong Kong, where you've got a sort of long tail versus a group of larger predominantly mainland Chinese corporates, you're looking at about 0.2% of the market trades every day. So I think there's this feeling that obviously the US was the place to migrate to, which I think, to Sharon's point, is less and less the case. I think, sorry, and this is my personal gripe that will make me sound like a very bitter man, but the other fact of the matter is banks get paid around about 5 to 7% of the deal when they take something to the US. I think for our markets it will all be much less than that. So obviously for a bulge bracket bank that is if a founder whispers they might want to go to the US, that'll suddenly get picked up. We've been speaking to a company on this side of the world where the majority of their revenue is Europe. They are very much thinking, well, for us then, obviously London makes sense, a lot of their partners, et cetera. They once whispered to a couple of the bulge brackets that the US was, and we've had to sort of and similarly, I think the biggest criminal one in this side of the world is the number of companies that you find that are not. They might just be a unicorn, and they've been doing PCAOB audits for 5 years. So basically paying 130% for their normal audit when they could just be doing IFRS, which would satisfy a local market or most global markets. So I think that slight sort of overreach and overselling of the advisors at times, and I genuinely do. Typically, the law firms, often global, so they'll work it out, and often qualified, as well. But I think there is a big part of that is part of the pain point for everyone apart from the US at times.
Thank you. That's a very helpful reality check. Okay. I wanted to come to another topic which is coming out of the paper, that is the point that maybe after all it's not so much competition amongst stock exchanges but also a competition to a new player, that is the private markets in this world. And so perhaps there is another elephant in the room that we don't have represented here, although I wanted to stay for a moment with Thom, because the London Stock Exchange has experimented in this space and has built a new market platform with a beautiful name of Pisces. So that stands for Private Intermittent Securities and Capitals Exchange System, if I got that right. So essentially a new marketplace where you can trade with private firms, private shares, and maybe you can tell us a bit about that motivation and the plan.
Sure. Thanks, Go. Pisces was that's the name of the regulation. That I think it was actually a backronym from someone at Treasury as opposed to ourselves. But it was part of the review process that we started off long ago. Was obviously looking at our listing rules, but we also said, look, companies are staying private longer. We're fine, we're a stock exchange, but really what we're here to do, I think to Chinese point, is really we're here to connect companies with capital. Is there a role that we could play? Can we listen to some of the problems in the private secondaries market as it stands today, and could we play a role there? So from the Pisces regulation, we have now launched our market called, very creatively as well, but a little easier to remember, the private securities market, or PSM. Essentially for secondaries only, a company that is private can come through putting out very limited amount of disclosure. This is very much about private markets up as opposed to public markets down. This is for them to put onto a platform 5 days before an auction takes place, using our existing auction infrastructure that we cross the market over with morning, noon and night. So using all of the existing pipes and plumbing, the CREST settlement system that we have in the UK. So turning all of that on for a private company, 1 day auction where and this is very much about giving the issuer agency. So the company is the one that is able to set a price range. They just have to put how they've come up with that valuation. Could be a previous private round, could be an independent third party, whatever it may be. Disclose that. And as I say, we have a set formula of about 17 different areas that a company has to disclose. There's only 3 that are mandatory around existing shareholders and so on. The others are more around investor expectation that you'd expect to see in a private deal, typically. That goes into a data room that we manage. There's the other side of it are sophisticated investors only, and it can either be one of an open auction, where those sophisticated investors could vary from the global brokers that everyone expects. Bank of America signed up there, Berenberg, Rothschilds, etc., but right through to we actually have some of the crowdfunding retail platforms as well, the likes of Forge Global, Crowdcube. So trying to really sort of democratize some of that private piece, but giving the company the agency, as opposed to some situations where you see accidental down rounds or funds just sharing between, trading between themselves. Once they've had that auction day, the shares are all settled, so it's T+2. Again, you don't have the huge delays that you sometimes see with private transactions. And then that next day, they go back to being a private company, so there's no ongoing disclosure. The only thing they have to say is whether this was a one-off auction, or now that they're in the system, do they want to do it again for next year, next 6 months, and just set out that that cadence of auctions. In terms of companies we expect to use it, we've seen a lot of interest from companies that stay private for longer, with a lot of either early stage investors or employees that have never had that opportunity to realize some of that value. And we've seen a lot of family-owned businesses that have approached us as well, who probably don't ever want to go public. And then we've also seen from this side of the world a few companies who have a very dominant shareholder that they'd like to sell down to try and help them look at other markets and things like that. But we're discovering case studies, new case studies, use cases every day. We've had the one transaction so far, Oxford Scientific Enterprises, a UK unicorn. We are going live with, I think these are rumoured in the press, but 2 more going live in a couple of weeks. So I think it's something that will, the more we use it, the more it's used, we'll understand how it sort of develops as well.
Right. Katsunori, Chinyi, would you like to comment on this question of private markets from your perspective?
Sure. So, but Thom, so what do I call the market? What's the name of the market?
PSM.
PSM, right.
Yeah.
I have a quick question, actually. And retail can participate in this market?
So it's sophisticated only, but the reason the retail platforms are there are high net worth. So as long as they're the platform saying, look, yes, this is a sophisticated investment, we're fine with that.
It's not traditional retail the way we think about it.
No.
Yep.
Yeah, so we've certainly been studying this with a lot of interest because, in this part of the world, we are probably one of the top in terms of the quantity of PE and VC funds and PE and VC activity. So, as you say, there are some companies which probably don't want to go public anytime soon. And the question is, do you serve them? I think in the past we've looked at facilitating trading, similar to what PSM is currently doing. Currently, I think the assessment is that the ecosystem is quite ripe for a lot of companies to consider between continuing to get private funding or with the market conditions looking more benign to go public. And as Sharon said, a lot of factors go into that, including the wider range of capital available and the prestige. So what we're doing is, as a start, moving downstream to engage likely partners across the PE/VC space, whom are very likely to go into considering IPO in the next 3 to 5 years, and working to see how we can make sure that they are ready, both in terms of the journey, giving visibility, as well as making sure that at least in this part of the world, with our reach, getting more familiarity by investors with the company. And you're doing so through a series of research reports, a series of profiling programs done in conjunction with PE funds. So our approach right now is that we want to facilitate their road to the public market.
Yeah. Okay. Thank you.
I would just add that this idea is very interesting because I think if you look at the US, I mean, there are not that many of those again, but Spotify went public in the US without raising a single cent, right? I mean, earlier when you talked about AvePoint, so Singapore is obviously no stranger to secondary listings. The reason we said that company was the first of proper secondary listing was it was the first that did a secondary listing in Singapore that also raised money, but it wasn't public money. We didn't. We actually did a private placement in Singapore to high net worth and institutional investors and listed at the same time. It wasn't actually available to retail. But I think building on the idea and the concept of what the London Stock Exchange has with what Thom is saying, it is very interesting because certainly the growth of private capital, venture funds, there is so much private money that is available in the system compared to when I started practice 20 plus years ago. And so the landscape is very different. And certainly when the tech bubble burst a little bit some years ago, right, we were seeing that these so-called unicorns, while they were on the brink of an IPO, most of them quite easily deferred the IPO and actually did secondary rounds. And so by the time many of these companies actually get to a listing, they are many little public companies already. In the Singapore context, if it's a Singapore incorporated company, if you've got more than 50 shareholders, not counting employees, you are a public company. And so many of those, in fact, were finding that they were tripping themselves up on the rules, potentially inadvertently triggering off takeover code implications because they became public companies, but just not listed companies. So there's definitely an avenue for that. I do think the interesting thing about that is it perhaps also allows the slightly smaller, so small and medium enterprise, because if you're a unicorn, or beyond a unicorn, you're ultimately waiting to list on a stock exchange, and you may not actually care whether or not you're raising capital at that point. But you are looking for that stock exchange validation. You are looking for vibrant public markets to allow your employees and your VC investors to ultimately exit even post IPO. But using that sort of 2-day settlement system is going to be very interesting. And I'm guessing a lot more cost-effective for these companies to then access the capital. So that's very interesting.
I think that point on the slightly smaller companies. I think in the UK context we saw a situation. Sorry, this is globally, but I think of get this wrong. 75% of private secondaries capital was going to the top 10 companies in the past few years, and it was all AI and so on. So even for a quite substantial unicorn that's not sexy AI company, it's been a real struggle. So I think that's also an element of using the exchange to do it, both in terms of us using the existing plumbing for the broker network, but also the fact that they're still saying we're listing on the PSM. I don't know if we even say listing. I need to check that. But part of that profiling as well, when it's so tough at the moment.
Okay. Kazuhiko?
My perspective is here. And the private market and the public markets are kind of blurred. And in Japan in the past, the private market, we didn't have enough player in the private market. That's why maybe around the Series B company could use public market for the fundraising destination. And currently, now we had a lot of market growth in the private sector, and then there are a lot of players here. That's why now in this area, private market is very much active rather than private market is very much active. But on the other hand, in the public market side, yes, as he mentioned, there are many of the investors focus on a much more larger size on sexy AI and then AI and dual use and such like very much investable in very much how to say good companies. So in that means now we are struggling. Of course, we have a kind of border between the private market and the public market, but at this moment now, of course. It depends on the players. We can share in this area together with the private and public. But right now, we are struggling because public players going to much more larger size. And this, in that meaning, this may around the border area between the private and public may be the kind of spot, yes, between the public and private.
Excellent, thank you. So look, the six of us are having a great time up here. If there are any questions from the floor, then please do come in. We have more stuff prepared, but we fear if we continue, then we run out of time. So maybe Merit.
So I guess noticeable was absolutely no discussion here about the regulatory environment in which each of these exchanges is happening, which depending on where a company lists, that can have effects on whether whether it's subject to mandatory disclosure or not. Obviously, regulation also is relevant to the level of liquidity in a market. And I guess I'm curious in terms of this discussion of stock market competition, whether that in turn has created pressures on regulatory authorities and what the nature of that pressure might be.
Who would like to respond, Chinyi?
Yeah. Thanks for that question. As I touched on earlier, especially in the recent review, the focus was on, first of all, identifying your target market, which were companies potentially seeking international listings versus Singapore. And then secondly, re-examining your regime and the way you implement your regulations such that the lived experience is consistent with what they would expect of any developed market with a disclosure-based regime. So what we had found out was that over the years in how we dealt with matters, there was what we call a merit creep, where more and more, instead of just simply allowing for disclosure-based or disclosure to be given by the company and for market discipline to then take charge of the pricing, regulators stepped in and applied their own judgment as to what was an appropriate manner of resolution of an issue. I mean, just as an example, in our listing rules, we had previously required that if there was a material control weakness identified by the company in its preparation for listing, it had to be resolved. And I think what wasn't written, but implicitly is that it's resolved to the exchange's satisfaction. So in this case, it wasn't simply a case of the company disclosing what the weakness is, what it plans to do about it, such that the market then has the autonomy and agency to decide. It was a regulator deciding what shouldn't be given to the market, and secondly, what should be done before you're allowed to come to the market. Now, as we looked at this and as we talked to the professionals, I think the overall message was, if this is a disclosure-based regime, what is the correct boundary of an agency between the regulator and the market? Because ultimately, as a pricing platform, market discipline is crucial. Because that's the force that determines what all investors view the price of the company or the value of the company is. For the regulator to step in and to apply its judgment can, in extreme cases, totally distort what the market is willing to accept. And in other cases, then make your market not the appropriate place to list. So that was one thing where we did a lot of soul searching and looked into how we can reduce confusion, how we can make sure that as a disclosure-based regime, if we say we are, what the lived experience ought to be. Now, having said that, I don't think it's a case that every exchange jurisdiction should do things exactly the same way. I mean, words are words, but the application of the word will be subject to local norms and local understanding. So in Singapore, for instance, our listing rules have a large focus on interested party transactions, and it's simply because a lot of the companies in this part of the world who list in Singapore previously tended to be family-owned. And they have built out their enterprise over the years with a lot of connected subsidiaries. So there's a lot of focus on that. I don't think that necessarily will be the case in some of the other markets.
I think we went on a very similar journey in London in terms of we'd always been we certainly shifted to being even more disclosure based, but we will always comply or explain. But over the years, I think to the point you made around whether it's advisors being nervous around getting something wrong, it had become a little bit more comply or else. So inbuilt within our rule changes was also a competitiveness mandate for the FCA, our regulator. So it's meant that they've had to consider how it weighs up against other exchanges. And I think Sharon's right. I really wouldn't describe it as a race to a bottom, but sort of a levelling out of going to a more disclosure-based regime. And I think the thing that's really driven that, as opposed to the issue, has actually probably been the investors more, where we used to have premium segment where there were extra levels of disclosure around related party transactions, around M&A and major transactions, which there wasn't an equivalent for either a private company or in the US. So when our premium listed businesses in London were competing in M&A, everything was based on a shareholder vote and made it much harder. So we've stripped all of that away to make it a bit more of a level playing field.
Super. The good news is there's big interest from the audience, and the bad news is we have only 10 minutes left roughly, so I suggest that we collect a few questions and then run through the group. So I have Umakant first, then Jennifer, then Eric and Jill. So Umakant goes first.
Thanks. So very quickly, I think one of the concerns often in stock exchange listing is listings gravitate towards wherever there's liquidity, and that came out quite evidently in this discussion. So to me, it seems like a chicken and egg situation. So how does an exchange build liquidity? And one of the efforts that we've seen in this part of the world is to bring in like enabling mechanisms like dual class shares, SPACs, but those have worked only to a limited extent. So is there any other kind of thing that mechanism that we can think of? Because some of these have been tried, but they work only to some extent. They create some enabling force, but not to the extent that we might want it to attract listings.
Jennifer.
Yeah, I just want to make a comment about waivers. I was interested, Sharon, in your view of waivers. I'm aware of a couple of waivers. I mean, obviously there are thousands of them, but a couple that were very controversial in Australia was when News Corp moved to the US and got a waiver for provisions that would have prevented it having a poison pill. And then more recently, and the thing that really bothered me about that was it was there was not good transparency. I actually got hold of the waivers, but I had to pay money to get them when I was writing an article on News Corp's move. More recently, of course, we've had the James Hardie matter, where James Hardie got a waiver so that it did not require shareholder consent for this takeover of ASIC in the US, and the Australian institutional investors went berserk over it. So I'm just interested in, the extent of transparency and disclosure of waivers across the various exchanges. And, the Australian institutional investors, I think, have got quite a lot of power. And so, there was a bloodbath at the shareholder meeting after that. So if you've got any comments on that, I'd be interested.
Great. Just wait a second. And Eric, no more question from you? Then Jill? Yeah?
Yeah, so Chinyu's point about related party transactions kind of opens the door to a bigger question about the role of listing standards in corporate governance more generally. And, we've had, the NASDAQ Women on Boards initiative. We've had exchanges banning dual class and then changing the rules and allowing dual class. We have the Texas Stock Exchange with potentially a new definition of independent director, right? So there's a lot of exchanges have played a big role, and some might say that that role is particularly valuable when you've got a large number of investors like index funds that can't benefit from disclosure. They can't pick and choose. They need the exchanges to set some sort of minimum standard. So I guess in light of that, the question is, is shifting to a disclosure-based regime kind of abandoning that function, and is it fairly characterized as a race to the bottom?
Since we have just a few minutes and we'll come to throw one more, since you don't have enough on your plates already, let me add one more question. We've had a lot of discussion today about geopolitics and its impact on corporate governance and markets, et cetera. And since we have this expertise here, how concerned are you about geopolitical splintering of the capital markets? Even in the SpaceX IPO, Hong Kong and Chinese investors are being excluded from the IPO. Are we seeing capital decoupling in the same way that we've seen trade decoupling and supply chain decoupling?
So what I suggest is that each of you can pick and choose from the different questions that came up, and we do one final round where maybe you start with on this side and then we run through.
Okay, thank you very much. I have a choice in the geopolitics. And
very good.
Yes, and currently now we're facing a kind of geopolitical difficulties even in the Asia region, and yes, U.S.-China tension in the past, regarding the IPO market under $100 million size IPO. Those companies could use the local market like Singapore and Indonesia and Thailand and so on. And 100 million to unicorn size, you go into Hong Kong market, and over unicorn size go into US market. But right now, Hong Kong markets are facing a kind of geopolitical difficulties. That's why many of them Asian companies cannot choose the Hong Kong market at this moment. That's why. And now, sometime, we have seen a kind of decoupling in the IPO market and fundraising destination in the Asian region. And that's why currently now we are seeing a kind of different kind of news of the dual listing. Yeah, in the past, very much larger side of the companies used dual listing in the major companies, major market. But right now, we are seeing a decoupling in each market. That's why many of the companies want to make more visibility in each market for making more business. That's why DR listing and something dual listing in the foreign countries, and now we are seeing a kind of new kind of demand in the dual listing.
Thank you, Katsunori. Thank you. Sharon.
Maybe I'll deal with the waivers one. That's certainly interesting. I think on the topic of waivers, I fully agree that waivers and disclosure absolutely has to go together, and so one without the other doesn't work. I got to go back and look at it, but I was very curious on the News Corp one, because if you're talking about an Australian company that's listing in the US, I mean, the US is clearly all about disclosure, and it has a very active plaintiffs bar, and so if the presence or lack of a poison pill was not actually disclosed, there will be reactions in the market. It's a strict liability market, particularly when you're doing an IPO. I do think that, if you think about from a regulatory perspective, one of the interesting questions will be, is it the regulator's job to ensure that if it is giving a waiver, that is clearly, splashed all over the website, or that the disclosure is made extremely clear. I think every regulator has a different way of dealing with it. Seldom, I think in most markets, will the regulator actually want to be responsible for the disclosure, right? And so it is highly unusual that a regulator would take that on. The SEC is slightly unusual in the US because all comment letters are available after the fact. So in some ways, you can find the disclosure. But I think the way most regulators would deal with it is obviously assessing all of the facts, and with the right disclosure and insisting that requiring the company to actually include it in the public disclosure will be important. Part of the issue is having also an active, in Australia, as you say, active institutional shareholders, but having active shareholder bodies, I suppose. So like SIAS in Singapore, like ISS in the US, those are important bodies because those are the folks that actually read the disclosure and tease out the faults, and provide that information as a service to the market.
Yeah, wonderful. Jinyu.
Yeah. Just a question on disclosures versus the corporate governance standards, and absolutely agree. Every listed company must have a level of corporate governance, and I wouldn't say it must go up all the time, but they must remain at a level that is representative of the fact that they are stewards of public capital. So I think what you have raised is a very, very, very good example of what the limits of the term disclosure-based regime means. And how we always look at it is that there is no conflict in terms of disclosure-based regime versus corporate governance, and I'll explain why. Because how we typically try to upscale corporate governance standards in our listed companies is really through disclosure requirements. Over the years, we have successively introduced, for example, the requirement to disclose a diversity policy for appointments to the board, i.e. you would have to have a diversity policy, and disclose how factors including gender and experience factor into the board's assessment of the diversity on its board. We have also required a sustainability report to be prepared. Thereby, in preparing the report, you would then have to consider your ESG obligations in the running of the company. So in this way, disclosure obligations is, in my view, a tool for us to push corporate governance standards, and where it's appropriate, we would then institutionalize it in the rules. We've introduced term limits on the independent directors, and we've introduced a mandatory disclosure again on remuneration of the top 5 earners, but especially for the CEO and directors. So you upscale the standards, but at all times through disclosure, and where appropriate, you mandate in the rules. Because I think, I like what Sharon said, it's about what's the correct role of the regulator in these matters.
Thank you. Thom has the last word.
I don't think any regulator wants to really be in the position to be giving waivers. I think obviously with the comply or explain regime, you have to be able to explain it to make sure that it's still in the interest of your shareholders. And I think that's the route that the UK tries to go. And then obviously is very current in terms of the index question, is it's not just the exchange, the regulator. I think we have to have that bare minimum. It then becomes the index providers themselves. Admittedly, we do happen to own one of them as well. Sorry. And then the other point around, yes, I mean, I had to get a subscription to AFR to fully understand what was happening in the Australian context. It was, it was quite something that I just don't think you'd have seen the FCA being comfortable doing that. I feel quite comfortable in the fact that I can pitch to companies knowing where they'll sit in our markets, which index they will or will not be applicable to, what they will have to comply with, what they'll have to put within their corporate governance, how they comply with it, their FPPP, we called it, the financial process planning procedures, all of these aspects. You know, we're pretty strict on all of that still, because we think that then gives you the access to be able to raise, to the point on the back there, liquidity comes in 2 forms. Yes, the daily trading every day, but also the ability to come back to investors and raise new capital. And that ability in London has always been very strong. I think Singapore doing a great job with their capital they're putting into the money from the government. The UK's approach is we have the 3rd largest pension pot anywhere. We're starting to put that both into private companies to make sure that then it's not just US VCs, PEs on the cap table when they get to IPO stage, but UK capital there as well. And also, we're guilty of, compared to this region, is we're a very institutional heavy market. So we've started putting agency back into retail investors and a big sort of push around that, because I agree none of this really means anything in terms of the rules and reg without the capital to support it.
Wonderful. I'm afraid we have to draw this discussion to a close, but it's been really, really interesting to listen to all of you. I could carry on forever. Thank you so much for having the time, for having made the time.
Thank you.